We next move on to the application of the benchmark approach to target date funds. So target date funds are designed for retirement investors to target a certain retirement date. It is generally advised that investors should hold more risky assets when the retirement date is still far in the future, and slowly move to riskless assets as the retirement date approaches. However, this quantitative design of this allocation process is not very well understood. So by applying the benchmark approach and the minimum market model, we can obtain such a quantitative approach to the asset allocation of the target date funds and provide a precise way of computing the allocation fraction as a function of time and risk preferences. So again, we consider a diffusive market model where we have a number of M primary securities, and we consider an investment portfolio pi, which consists of investment in the risk-free asset, such as a savings account, and the risky assets. So the value process for this portfolio is given by the sum of the riskless asset plus the sum of the wealth in the risky asset. And we consider a retirement date T, where we assume that the terminal wealth of the portfolio is a random variable measurable with respect to the final the information set ft at the final date, and we assume it's a strictly positive or non-negative is an LP random variable. So our objective is that given a budget, some kind of budget constraint, we would like to maximize the expected utility of this terminal wealth. So we make several assumptions. First, we assume that the utility function satisfies these conditions of being twice differentiable, concave, strictly concave, and start from with a derivative start from infinity and ends up being flat toward infinity. So we also assume that this utility function satisfies a growth bound, polynomial growth bound, and all these conditions are satisfied by this Carré utility given by the next expression. So our objective is to following the benchmark approach. We know that all we have to do is design the terminal payoff random variable subject to constraints, and the real-world pricing formula will give us the optimal asset allocation. That is a strategy that realizes its terminal wealth V. So the problem is to maximize this expected terminal utility by designing the random variable Vt, which is a LP random variable instead of L2. So the budget constraint is that the initial wealth is given by this expression. So this initial wealth is given, and the terminal wealth random variable is to be designed. And this is a minimal pricing formula, that is a real-world pricing formula. So we make the next assumption regarding the GP, which satisfies these conditions. And this assumption is sufficient to guarantee that if P is greater than 2, this optimization problem is well defined. So we can show that if these conditions are satisfied, the optimal portfolio process can be calculated using this formula. And the optimal asset allocation at time t is calculated as this formula, where the investor only need to invest in 2 assets, namely the gross optimal portfolio S star and the risk-free asset, the cash. So next we conduct some simulation studies. So we first simulate over 30 years of the GP price process over 40 years. We use a parameter, we use a minimum market model, and the parameters are estimated from historical S&P 500 price processes over the same period of time from 1978 to 2018. So we consider two different investors with different risk aversion coefficient, one with risk aversion 5, the other with risk aversion 0.8. So the first investor is highly risk averse, and the second is not risk averse, is more risk seeking than a logarithm investor. So we have shown here on this plot the projected and realized return distributions across the 1,000 simulated GP path following the corresponding optimal asset allocation calculated under the minimum market model and the benchmark approach. So what we can see from here is that the risk-seeking investor realizes returns that a much wider spread. So under different scenarios, he will get different returns, whereas the risk-averse investor realizes relatively stable returns, regardless of the with a much less variance. And the 3 columns correspond to 3 different time horizons: 10 years, 20 years, and 40 years. As you can see, as the time horizon becomes longer, the return distribution becomes less risky with smaller variance, especially for the risk-seeking investor. So the in-sample and out-of-sample cases are very similar because there's no model inaccuracies here, as the simulation and the pricing are conducted under the same set of parameters. On the other hand, the risk-averse investor will realizes relatively less mean returns with much less risks. This is all well understood and well anticipated. So here we have some more detailed So next we consider backtesting with historical data, where we consider the realized sample path of the S&P 500 over the 40-year period, and apply the estimated strategies calculated from the benchmark approach and minimum market model, and we compute these returns for 3 different time horizons and for 3 different risk aversion coefficients. So here gamma equals infinity refer to absolute risk aversion, which means the terminal payoff is supposed to be deterministic. It's a fixed value. What is interesting to see here is that the realized return for 10 years is very close to 0, which is more or less agreeable with classical theory, which states that no risk, no return. By the way, this return is excess return, so interest rate has been discounted. So on the other hand, as the time horizon increases, the return start to become non-zero. So for 20 years, they are somewhere between 6.6% and 2.8%, depending on across these different scenarios, where in sample is such that the parameter estimated is estimated through the entire set of data from 1978 to 2018, where the out of sample refers to the situation where the parameters are estimated from S&P 500 data prior to 1978. So TC here stands for transaction costs. So by adding 0.5% of transaction costs, the return is slightly affected, but still they roughly agree with the projected values and realized values without transaction costs. So at 40 years, the average the return on the realized sample path is about 2.5%. This is excess return with absolute risk aversion. Whereas for other risk aversions, the return increases by decreasing risk aversion coefficients, as you can clearly see from here. So here's some plot of the price process of these invested TDF portfolios, as well as its risk asset allocations. So this is for 40 years. And the 3 columns correspond to the 3 different risk aversions: infinity, 5, 0.8. So for infinite risk aversion, as you can see, near the end of the period, the portfolio value stays pretty much constant. But as the horizon is still far away, it is risky. It is not. It is invested partly in the risky asset. Toward the end of the period, most of the assets, or all of the assets, are moved to the riskless asset. So the black curve here shows the risky asset allocation. So initially it's 80%, and at the end of the day it's 0%. And the blue curve here shows the normalized GP, which shows a mean reversion pattern, and it can be seen that the asset allocation is negatively correlated to the normalized GP, which means that if the GP increases, the the, the strategy will sell some of the risky assets, and when the normalized GP decreases, it will buy more. This is all due to risk aversion and mean reversion. Similarly, we can see similar patterns for for risk aversion coefficient 5, where the initial investment is highly risky, nearly 80% plus. And toward the end, it is decreased to around 20%. So initially, the investor will put most of his wealth in the risky asset. As the target date approaches, the investor will move his wealth gradually into the riskless account, so that the terminal asset allocation, the short-term asset allocation, correspond to his risk aversion coefficient 5. For the third investor with risk aversion coefficient 0.8, he's more risk-seeking than a log investor. So that, as you can see, his risky asset allocation actually increases over time. So he starts from somewhere close to 1 and gradually increases his risk exposure as the target date approaches, eventually reaching the level of short-term risk, a short-term risk aversion target. So this investor who is more risk-seeking than a log investor will take on leverage, which means he will borrow money to invest in the GP, but he will not do so when the time horizon is still far away. He will start to borrow money when the time horizon approaches. So the more risk-averse investors will follow a reversion strategy, where when market grows, they will cash out, and when market decreases, they will buy more. Whereas the highly risk-seeking investor will buy more when the market grows. So he follows a momentum strategy. So next we look at some historical simulations. So we previously looked at historical backtests with a single realized path. Now we are considering historical simulations, where we have simulated, based on the realized path, a number of sample paths by essentially resampling the risk factors, realized risk factors, and generated a collection of sample paths. And we conducted the same exercise on the historically simulated path. And we summarize the results, outcomes in this table, where we consider 3 different time horizons and 3 different risk profiles. We see similar patterns where for the investor seeking riskless returns, if the time horizon is 10 years, he is able to realize on average 0.1% of excess returns. And for 20 years, that excess return becomes about 1%, and for 40 years, it becomes about 2.5%. Recall that under risk-neutral approach, riskless excess returns will be equal to 0. But under the more general benchmark framework, it is possible to realize riskless returns over a long enough period of time. And for not so risk-averse investors, they can realize more returns at the cost of the increased variance or risks. Whereas for highly risk-seeking investor, they will realize even greater returns for shorter period of time. And for a longer period of time, it still realizes much higher returns than more risk-averse investors at higher risks, of course. The reason why they can realize even more returns at a shorter period of time is because if the period of time is short, if the time horizon is close, they are going to take on more leverages. And because the realized historical returns are bullish over the last 40 years, taking more leverages, of course, will increase their returns. So this is the target date funds. Next, we consider long-term auto investments with subjective preferences. Again, we use the S&P 500 as the proxy for the GP. And we work on the benchmark approach and the minimum market model. We consider an investor whose investment objective is not expected utility, but those under the cumulative prospect theory. So in this study, we show how these optimal strategies can also be constructed for the CPT investors under the benchmark approach. So the utility of a terminal wealth, VT, for the CPT investor is given by distorted expected utility, where the utility function U has a distortion W, where the CPT investor will have subjective preferences of distortion on the probability of events when the return is positive or when the return is negative, or when for bullish and bearish market conditions. And the optimal investment problem is formulated as to find the optimal terminal wealth that maximizes this distorted expected utility and the budget constraint specified by the real-world pricing formula. It turns out that this optimal terminal wealth is given by the next expression, where M and V plus star are constants. Sorry, M is a constant, V plus star is a random variable, which is a solution to the next optimization problem. K1 and K0 are constants. So the V star plus maximizes this expected utility under the distortion W. And it satisfies this particular budget constraint where the initial budget is a constant to be determined. And for this optimization problem, the solution is written down here as given by the next expression, where this h function is given by this expression, where the h down arrow is its L2 projection onto the set of monotonically decreasing functions of this function ht. ht is defined from 0 to 1, and q is the quantile function of the random variable terminal gp s star at capital T. So finally, the optimization problem becomes to maximize over 3 parameters, k0, k1, and lambda, of these distorted expectations under these constraints and the budget constraint. So initially, our objective, our optimal investment problem is a functional optimization problem. That optimizes a random variable. Finally, this problem is reduced to a 3-dimensional optimization problem that optimizes over 3 parameters. So next, we'll consider some numerical experiments where we use a utility function, which is an exponential utility function. We fix that. This utility function also differentiates between a gain and a loss over this constant m, which is a minimum, which can be regarded as a minimum level of wealth that the investor would want to maintain. So if the wealth is beyond m, the terminal wealth is less than m, the investor is risk seeking. So it has a convex utility function, whereas if he has more wealth than m, then he will be risk averse. On the other hand, the distortion function is given by the next expression. And we consider 4 investors with the same set of parameters defining the utility function, S-shaped utility functions, and distortion. And the distortion parameter, beta, will be different for the 4 investors. The greater the beta is, the less the distortion is. So here's a plot of the utility function, where it is convex below some level and concave above that level, and this distortion function, or weight function W, is heavily distorted if beta is small, and becomes pretty much linear when beta approaches 1, and this is a positive part, and the negative part will be the reflection of these positive plots. So after carrying out the numerical optimization of the optimization problem for the investors, we calculated these parameters for the optimal terminal wealth for investors number 1 through number 4. They have different levels of K0 and K1, where K0 is the level of wealth, level of GP, below which the investor will give up on all wealth, so that the optimal terminal wealth below K0 will be 0. between K0 and K1 will be a constant M, which is a minimum welfare level. And above K1, if the GP is above K1, which means the market has a good enough outcome, then the investors will become risk averse, so that the terminal wealth becomes a concave function of the GP. Depending on the subjective distortions, if there's more distortion in the subjective view of the investor, for example, investor number 1 with beta equals 0.3, he will be more optimistic about the market, so that when GP grows, his optimal terminal wealth will increase almost linearly with GP. But for investor with a relatively objective view about the market, he will have the correct concavity shape of his optimal terminal wealth. And the realized wealth for investors, given the realized GP, is such that the investor with the most subjective view realizes more wealth, more terminal wealth, because he believes in the market growing fast, and his subjective view put more weight on the scenario where the market is bullish, and which turned out to be the case for the realized GP S&P 500 for the last 40 years.